Well, the big deal of this week was the power company AGL pushing the button on a $900 million capital raising after the ACCC gave it the go-ahead to buy out the remaining two-thirds of the Loy Yang power station in Victoria. AGL says buying the brown coal generator is a good deal with or without the carbon tax. Here's CEO Michael Fraser.
In our base assumptions, we've assumed that there is a price on carbon. We've assumed that that carbon price is consistent with the Treasury modelling out to 2025 and then CPI thereafter on it. So we've baked into our assumptions that there will be a price on carbon. Obviously, then if there isn't a price on carbon, then as far as Loy Yang is concerned, that's upside to the basis upon which we've bought it. You would describe us prior to the Loy Yang acquisition as having been long carbon and therefore, very biased towards making sure renewable policy and carbon policies remain in place. And we remain very firm advocates for those policies. But that having been said, this acquisition not only balances our book in terms of our retail load and our generation capacity, but it also balances the books, if you like, in terms of our carbon exposure, and so in effect de-risks AGL's business.
So Michael Fraser there basically saying that AGL is hedging its bets whether or not there is a carbon tax. I guess the issue for the markets is the way they're going about the capital raising as well, raising $900 million.
Yeah, it's fair. They've done this as a renounceable rights issue, so the institutional component's accelerated. The retail component gets to trade at the same time. So that's a real advance on, say, the Bank of Queensland raising. Interestingly, it's the same underwriter. I think Citi are one of the co-underwriters, so same clowns, just a different circus. And this time, retail shareholders and instos have been looked after equitably, which is a really good thing. There
is a fairly heavy discount on the AGL raising. Is that an issue, though?
No, it isn't. It isn't. It's really a question, because it's a renounceable issue, people can sell. But the major issue really is whether it's good value. It looks like they were really the only buyer for that asset, and that they've picked it up, for a pretty fair price, I'd say.
And Peter, is this the sort of stock that investors would like to pick up in this environment?
Well, I think, listening to what was said there, maybe I'm a little bit dumb. I'm not quite sure what was said there. I mean, it seems to me to be an expensive hedge to try and hedge a position, raising $1 billion or the like. So you've got to take management on trust as to what they're doing. I mean, AGL typically is a defensive asset, but there is risk with any acquisition, and that's a big acquisition they're making, and in a pretty uncertain environment where risk is the key to being priced correctly.
And talking about risk, we hear that some of the energy regulators around the country are looking at raising their prices. What sort of impact will that have on the risk profile for people like AGL and Origin even? Well,
I think it just adds to the risk equation. We're in an environment, whatever the pricing of a security is, that risk is now becoming the dominant force in being priced correctly. And with the repricing of energy and the like, with the uncertainty of the carbon tax and where it's going to be in 2 or 3 years' time, I mean, all that is is hard to price, and that's why the acquisition pricing has to be right from day one.